Well, hello, everyone, and welcome back to the PetroNerds Podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds Podcast, and I am absolutely pumped to be with you here today. This is episode 150 of the PetroNerds Podcast. That is just an awesome number. I am super pumped to be there. So episode 150 of the PetroNerds Podcast. Today it's the morning of Wednesday, February 11th, 2026, and we have a round the world tour to get you covered because this podcast is an absolute special. This is the episode or the podcast that I did at the Denver Earth Resources Library on November 5th, 2025. And this is a very star-studded lineup. So I have Joe DeDominic with Anschutz Exploration. I have Tad True with True Companies and Bridger Pipeline. And I have Nathan Anderson with the North Dakota Department of Mineral Resources, all on a panel at the Denver Earth Resources Library. So this is a very heavy-hitting talk on the Rockies. We cover the Powder River, we cover the Bakken, we cover the Uinta, we talk about the midstream, we talk about oil prices at the time, which were about $60 a barrel. So a lot there. But before we get into this, I'm about ready to head to Washington, D.C. So I'm going to get to jump on a plane. So I'm going to try to keep this short and sweet and tight. But we have a lot of ground to cover because it is February 11th, 2026. We had a gap in the podcast because I was doing some transferring over with the website, but we are back in and running, and we have a lot in the queue. And right now, what I'm going to focus on this morning, we're seeing some really nice footing with oil prices. And what's fascinating is I am not seeing pundits getting on TV like crazy and saying, oh, let's talk about $65 oil. And that is because all the pundits have been on TV for weeks telling you that oil prices are lower, and that telling you when we had the effective seizure of Maduro, that when oil prices went down, that was the correct market signal. Absolutely not the correct market signal. So I think there's several dynamics at play right now, but what we are seeing today, Wednesday, February 11th, 2026, where we are seeing right now is $65.20. That's an awesome number to wake up to in the morning to see a 65 handle for oil prices, especially in the U.S. shale patch. We're seeing Brent at $70 a barrel. We're seeing Henry Hub at just over $3. It's $3.18. So nat gas not looking so good, and we'll get into that because production, especially in the month of November, has really come up along with prices. So the 10-year yield, we're looking at 4.159%. So a lot of that's happening right now. There's two big things happening on the headline numbers with oil, and that is a little bit of optimism in the economy, and it's all about Iran, and we'll talk about that. The optimism in the economy, though, is really based on we had the jobs data came in better than expected. It was essentially more than double. It was over 130,000. I think expected was 65,000. There's a lot of talk. You can have whiplash if you're watching the stock market in terms of the retail sales data, the jobs report, this K-shaped economy. Is it good? Is it bad? It's a mess. But the point is there's definitely some trading happening on the oil trade side that if you're looking at the headlines of why oil's up today, it's really Iran tensions and concerns with Iran. And it's about this better than expected jobs report, and meaning that the economy's doing okay and people aren't going to stop driving anytime soon. Newsflash, people, unless we go into a massive recession, people don't stop driving. But we did lose oil demand in 2008. So that's what people think about. So 30-year mortgage, we're looking right now at this 30-year mortgage. If we have pressure, if we see the 10-year yield go down, you will see mortgage rates go down. Right now, we're still looking at the 30-year mortgage well over 6%. So that is one of the biggest things you're hearing the Trump administration talk about and everyone talk about is getting mortgage rates down so that we make home prices more affordable. That is really tricky when you have this debt, and it's hard for even the Fed to impact the long end or the 10-year yield curve because, as I've told you before, when Jerome Powell, when they lowered interest rates a full basis point and did those big cuts, actually the 10-year yield went up by a full percentage point as well. So gold, a lot is happening in the market as well when we think about just the dynamics with, holy crap, we haven't spoken in a couple weeks. So we're looking at gold prices at just over $5,000 an ounce. They had ratcheted up to almost $5,700 an ounce. Then they came crashing down, and now we're kind of back to normal. Now, a lot of what was happening there, and this does impact oil, is that when you have a lot of trading in commodities, there's only so much money to move around. So there was clearly a lot of speculation going on. There's a lot of speculation going on within China. China does not have a rigorous, hardy stock market like us. They don't have SEC filings. And so people don't invest in companies the way they do here. And so in China, where you have these bubbles, like in property, where everybody throws their money into property because that was giving them a return, then you have a correction. They did this with gold. And so people were buying on margin and there was all kinds of craziness. And so you can see how it could go up very quickly and then come back down. But it's very important because that does impact oil and other trades, that there's only so much money in the system to be trading. And so you could have oil kind of sell off, even though it shouldn't, when you have some sell-offs there. And we didn't see the same love, like oil and silver have seen a lot of love this year, partly because a lot of speculation, although that craziness in China, but also because of massive geopolitical risk. And so oil is just now starting to feel that love a little bit. And I want to summarize this. There's a lot going on within the oil market, but I'm going to try to summarize this kind of within a 10-minute kind of recap of really what's happening. And then, so firstly, this is about Iran, right? So we didn't have enough geopolitical risk priced in oil to begin with. We probably only have $4 to $5 at most priced as a geopolitical risk premium into oil now. So that $65 handle you're seeing, I've been saying for months, almost a year, that that's basically where oil prices should be. This is where oil prices should be. And really probably doesn't even have that much of a geopolitical risk premium in it. $70 Brent is not bad. We're probably or natural level, we should probably be 75 Brent, more like 65 to 70, for WTI. And that is because we have, yes, we have a lot of supply, which I talk about, but the supply that everyone talks about, this oil glut, all this oil on the water that everyone talks about, this is sanctioned crude oil from Venezuela, from Iran, and from Russia. And Russia is moving all of this illicit crude oil. So it's really important to think about with what's going on with Iran and what's going on with Russia and Venezuela. There's a lot kind of up in there still in Venezuela. We are getting, I think some of that crude oil is coming into the U.S. and we are processing it into refineries. But Venezuela was about 1 million barrels per day. I think in the run up to the effective seizure, we were only seeing probably about half of that get exported. This is not detrimental to China necessarily because China's stockpiling like crazy. However, this is how Venezuela was repaying China's debt, right? So this does impact, I think, the Venezuela thing has much more to do with a effective sort of gut check for Russia and China in our backyard. But that being said, you still have this few 100,000 barrels a day that's kind of unknown. What are we going to take it? Is it going to go to China? What's going to happen with it? Cuba is not getting this, and you're saying that Cuba is not doing well because of this, because we have essentially a blockade of this crude into Cuba. So there's a lot of moving parts there, but that if you're kind of not moving that around or it's not getting to market, that would help push up oil prices. And then you look at Iran, and that's where the biggie one is right now, is that so Trump has not executed a strike on Iran, and we have had multiple weekends of talks. And so, as you know, from over the course of this year, but also last year, especially over in June of 2025, when we had the strikes by Israel and the U.S. on Iran, we were in the midst of negotiations, and then we struck their nuclear facilities. Now we're talking to Iran, and Trump is getting on TV and saying, hey, they should make a deal. They should want to. Now, they should want to make a deal. But the reason we have put all this armada that we've sent, a massive military architecture and Navy that we've sent more than we already had, and we're positioning them in the Middle East, is because the Iranian regime, and I'm not saying they're going to collapse anytime soon, but they are in a more fragile state than they had been probably since the 1970s. And so you had incredible protests, like absolutely unprecedented protests within Iran that struck all across from the end of December through parts of January, that struck all across Iran. And then Iran had an unprecedented crackdown of killing up to 20,000 people. And so you're just now seeing, and then a full internet blackout. So that's why you haven't heard anything about it. And so the news and the media have just done a deplorable job of talking about this. This is what's been going on under the hood, and why oil prices should have been at 65 a long time ago, folks. So that's taking place. Now, Iran produces 4 million barrels a day. They actually produce more than that. I think if you're looking at EIA data for international data, Iran's about 4 million barrels a day. Iraq is just over 4 million barrels a day. Super importantly, OPEC data for January shows that in December, Iran was producing just under 3.2 million barrels per day, showing that Iraq was producing 4.1 million barrels a day. They have Saudi above 10. Now, I point this out because I don't believe I think that the way OPEC counts their production, they take out condensates, they get really fun with the numbers and sort of some magic math. They show Russia well under 10 million barrels per day. Russia's well above 10 million barrels per day. But this matters if you're including all the liquids, like total liquids output, total refined product, everything. It gets a lot higher. So you're looking at Russia over 10 million barrels per day. You're looking at Saudi Arabia well over 10 million barrels per day. So you can see we have this well-supplied market. Iraq is really important, though, folks, because Iraq has gotten very, very cozy with Iran in the past 10 years. And the influence of Iran into Iraq is huge. Iraq is, I think I told you guys a few weeks ago, is that Iraq actually sees an oil field. They actually have ownership, I think, of West Qurna too. I don't think this is a good sign for folks that are trying to step out, particularly folks that are talking about stepping out of U.S. shale into the world. I actually think the best place you can put your money and the drill bit is in the U.S. I know that's hard. It's harder to get assets these days, but I think increasingly, especially if we see some footing at 65 and we notch towards 70, you're going to see folks increasingly very, very interested in going deeper, just doing more in the U.S. And we'll touch on the U.S. before I close in just a little bit. But back to Iran. So what you're seeing with these oil prices is that Iran is saying, hey, we are negotiating. And so essentially the last few weekends, you have had talks. You've had U.S. and Iran doing talks within the Middle East. And so they, at the end of the weekend, they basically come out and say, oh, they were constructive. But nothing's really happening. And so I think it's both the U.S. is trying to figure out what's the best way we could strike them and what would we effectively do? And nobody wants to just strike and then you create upheaval and nothing actually happens. You have a full-on war. Iran closes the Strait of Hormuz, and then you have a mess. Now, the Strait of Hormuz, that's what folks are worried about, has actually never been closed. In June of last year, when we did the strikes, folks within Iran were talking about voting to close the Strait of Hormuz. They've never actually done it. Roughly 20% or about 20 million barrels a day flows through. There are increasingly more pipelines by folks within the Middle East to bypass the Strait of Hormuz. But the question is, if they close it, how long would it be closed? Would it get reopened? All those questions. And also, I do believe that the Iranian regime is not in a good spot. You do not have those types of protests, and you do not kill 3,000 to 20,000 people because you are in a good spot. You're doing that because you don't have control, and this is your way to enforce control. So I just listened to a BBC podcast. That's the first time they've actually been able to film within Iran and air. They cannot air it within Iran. They could only air it outside. And really, people were not willing to talk to the BBC because they were so fearful for their life. So it's a really bad situation within Iran. They've had incredible inflation. They were talking about food costs going up like 70%. People do not have jobs. These protests were largely young men and people who didn't have jobs that were very, very frustrated. And so it's a really serious thing that's happening there. But super importantly, what Iran is asking for in these negotiations, they say they'll talk about nukes. They want missiles off the table, and they want their, funding of these extracurricular activities, these Hamas, Hezbollah, and Houthis. They want that also off the table. That's ridiculous because what Trump administration is saying, we want you to stop funding no more missiles, no more funding Hamas, Hezbollah, and Houthis, and we want nukes. You got to kill your nuke program. And so that's where negotiations are at, and that's why oil prices are steadily creeping up. Is because we do have a lot of bases within the Middle East. They are preparing. The United States has issued warnings to folks, if you're an American citizen, to get out of Iran. So essentially, I would say, honestly, the Trump administration is looking to see what their options are on strikes and what could be effective. I would absolutely not count that out of the cards at all. And I would certainly think that, they also talk about people saying that nobody wants a war in Iran. I think strikes when are probably something to be really thought of very, very seriously because Iran is not being genuine in the talks about negotiations right now. Okay, so that's your little recap on Iran. Now, with China, China's taking, if Iran's producing 4 million barrels per day, and I think they are, and that's sort of what the latest data shows, that China's taking about 2 million barrels a day of that. So China is going to get impacted a lot if we are actually sanctioning these vessels. And there's talk about, the U.S. seizing these Iranian vessels. I think we should have been doing that a long time ago because that's really where the money is coming from. So that's where they're getting this money. Sorry, that's my German Shepherd in the background. Okay, so that's where Iran's getting this money. They're getting it from all these oil purchases and these oil shipments, which is coming from China. So China's a big, big factor here. So is Russia. Now, super importantly is that China right now, if you've noticed that we've had this India has been in the news because we are working out this deal with India. India's been taking a lot of crude oil from Russia. The Trump administration, everyone has not wanted India to take 2 million barrels a day from Russia. India has said they're taking less. They are taking less. They have not stopped. It has not gone to zero. But importantly, China is sopping up those barrels. And that was a big question for a lot of folks within the market, was China going to absorb those barrels? And I've been telling folks for a long time, China is stockpiling like crazy. We're talking 1 to 2 million barrels per day easily that they're stockpiling. That's a lot of crude oil. And so if they're absorbing these Russian barrels, that's a big deal. So if they're absorbing another million barrels a day, that means they're maximizing probably over 1 million barrels a day on pipeline. They're probably getting 2 million barrels a day via seaborne imports. So very, very big deal. And that's just what we're seeing. We sort of see and track the seaborne. We don't see as much and have not nearly as much clarity on the pipeline, and more could be coming through on that side. So a lot of this, as you can kind of tell, this is where this oil glut, and I'm not saying this is real demand by any means in China, but it's still taking place and it's still impacting the market. Okay, and then lastly, I just want to close, which I think is very pointed with this conversation. We're going to have this awesome podcast podcast you're going to listen to from the Denver Earth Resources Library on November 5th with these heavy hitters on a Rockies conversation. Really, we close and we talk about the overall market and prices, and we talk about peak shale. And so super important to talk about peak shale before I close is that, look, we're looking at oil production. They revised the data from EIA in the U.S. They did it on February 6th, and we're looking at just under 13.8 million barrels per day. Importantly, they revised kind of the previous months, September and October, where we were around 13.8 million barrels per day. So we sort of had this grinding forward at this 13.8 million barrels per day where we're at right now. And this has been, last year where the prices weren't as bad necessarily as the sentiment was quite bad. So what we're seeing is that completions have held up, lateral lengths have continued to increase, and that is holding things up. This we will talk about a lot in the forthcoming podcast, which is what I talk about Oil Day in Oxford. We'll get into the weeds on that. So stay tuned. But really, really importantly, folks, on the gas side, we saw these massive price spikes up to $7 an MCF for Henry Hub on natural gas prices because of that incredible cold winter snap that we saw in the past weeks. We are now seeing, obviously, gas prices are less than half of that, but we saw natural gas production really respond to that bump up we saw in November when, if you remember, I was in Oxford and traveling and everything. We saw that big bump up in LNG exports, material bump up about 5 BCF a day, 15 BCF a day in October, going to kind of 20 BCF a day in November. And we saw natural gas production respond to that. So gross withdrawals went to 134 billion cubic feet per day. That's so impressive because the next largest producer in the world is Russia, and they're producing about 62 BCF a day. So just super, super important to watch that, folks. As of the week of one of the latest weeks in February, the most recent data from EIA, we are exporting just under 20 BCF a day. So it's a huge material number. So the fact that we're exporting 20 BCF a day, we're producing 134 BCF a day gross withdrawals in November, and we're sitting at $3. It tells you that if you're calling for peak shale, you're probably not looking at natural gas. I had a great conversation with colleagues and friends last night at dinner, and we were debating this or just talking about this as like, you put the drill bit in the ground for natural gas. If you give the signals, we have the production. And so I'm going to be speaking, folks, at NAPE on the morning of February 18th. So if you're down there, please take a listen, because I just spoke with the moderator of the panel, and we are going to be talking a lot about this of AI and demand and electricity prices and how much nat gas. We're going to talk about China. We're going to be talking about geopolitics. We're going to cover the gauntlet, and I'm going to be full stop on the record. So get there, ask questions. It's going to be awesome. And then please take a listen or show up and come to the talk I'm going to give at Liberty Oilfield Services, or now Liberty Energy here in Denver. That is going to be at 3 p.m. on February 26th. So that is going to be a huge deep dive. That's with the Denver Energy Network. It's with the Women Oil and Gas Association. So it's going to be fantastic. Yes, men are absolutely invited. So please show up. I think it's going to be jam-packed. So thank you guys so much for listening. I'm headed to Washington, D.C. I'll have a lot to fill you in on after that trip because I'm talking to some heavy hitters there. So folks, thank you guys so much for listening, and I'll talk to you soon. Enjoy the podcast. Bye. Thank you guys so much for being here. I am on the board of the Denver Earth Resources Library, and this is the third year I put a panel together. So it's been really fun. This is an awesome turnout, by the way. So Andrew Haney's in the back. He's been on the panel. I was on the panel. I made someone else do the moderating. Last year, I had a friend of mine from NCS Multistage and Lane Weirs from Liberty, and we had an awesome nerd talk. So today is an absolute treat because we have three incredible panelists. I know them all personally. I count them all as actually good friends and colleagues. I've known Tad for years. He's been a friend and colleague, and also a client of mine. Nathan Anderson is a client of mine, and Joe DeDominic was my former boss, and has also been a client of mine. So I know these guys well. They are incredible leaders in their own space. Tad is the COO of Bridger Pipeline. He's with True Companies and can give us a little more background and context. His wife is also awesome. She joined us here today. Nathan Anderson is the head of the North Dakota Department of Mineral Resources. He recently replaced Lynn Helms. And Joe DeDominic is the president of Anschutz Exploration here in town. So with this group, we have a wealth of knowledge from the Rockies. And so we can talk about, where oil prices are at, and we can give a little context. And these guys are welcome to ask me questions. You guys are welcome to obviously ask me questions. But we're going to try to do this very Rockies focused. We are all over the map with this year in terms of volatility. This is a very, very unique year. I don't know if I would say unprecedented geopolitical volatility, but we're pretty darn close. I would say we have more geopolitical volatility that anybody would have thought with $60 oil. Like it just doesn't compute. But $60 oil is pretty meaningful in an environment where we're sitting at 13.8 million barrels a day of crude oil production. And we have production in the Rockies, which we can talk about. I'm going to throw out a theory I have, which is that I have long thought Denver might be dead and out, right? Because the regulatory environment is so bad in Colorado. However, the private equity interest and the interest to step out of the Permian is so high that I think Denver could actually see some breathing in some new life, because everyone I talk to is interested in the Powder, is interested in the Uinta, is interested in North Dakota, and they simply can't get their foot in the door. So with all of that, thank you guys so much for being here.
Thank you.
All right, so we're going to start off with, I'm going to start off with you, Nathan. Why don't you give us a little background on, you're over 1 million barrels a day of production in North Dakota. You're new to this position, but you're in the business. So tell us what's going on in North Dakota right now. You have over 1 million barrels a day. You've held up production with 30 rigs. You've got these monster laterals with cord. Give us some context of what's happening, and how are you managing $60 oil?
Yeah. First of all, thank you, Trish, for having me here. It's been nice being back in Colorado. A little over a year ago, I moved to North Dakota to replace Lynn Helms after he retired. It was a big move. I spent my first 26 years in the industry here in Colorado, so I grew up here, and it's been good to see some former colleagues, some of which are here. Good to see you all. And my wife is from here, my kids are from here, so really nice to be back, but also nice to be back in my home state of North Dakota. Relative to the North Dakota climate right now, we produce about 1.15 million barrels of oil, 3.6 BCF of gas. We have a very, very slight decline in oil production at $60 oil. That doesn't surprise me. We have 28 to 30 rigs running at any given time. The decline, the lower oil price environment has actually been positive from a technology and an innovation standpoint. What I've seen through this is as the core of the Bakken area gets developed, operators are moving out to more the fringier parts of the basin. But what's really driving economics out there now is longer laterals. So I would say we have the trend right now is about 35% of our laterals are greater than 2 miles in length. We've issued close to 60 4-mile lateral permits in the state in the last 12 months. So that trend is really on the rise. The other things that are happening, U-shaped laterals are allowing operators to get into areas or some shape of lateral, whether it's a J or 2 miles out and 2 miles back, so a 4-mile lateral. Operators are doing those type of things right now. So lots of innovation and technology in North Dakota. Largely, I think, fueled by this $60 price environment that we've been in for quite some time. So that's kind of the high level of what's going on in the state right now. Yeah. Okay. How we're navigating the $60. I mean, like I said, 14 frac crews running in the state, 28 to 30 drilling rigs. Every month, I put out about the end of the third week of the month, I put out a director's cut. And it kind of gives the high level of what's going on in the state. And if anybody wants to take a look at that, you can look at that. I have another North Dakota colleague over on the right. Kayla's here, so she can provide information on how to get that. We've also got some paper copies of the most recent director's cut. So anytime you want to look at that's a good resource for people to get the high level on what's going on in the state. So.
Awesome. If you want to hand the mic. So I'm going to start high level here, and then we're going to dive into the weeds, and I'll ask these guys a little more questions. But Joe, you are sitting you're in the heart of the Powder River, and you are a geologist, which every geologist, so awesome. I love geologists. I love the rocks. That's why I'm part of the library. But geologists love the Powder River. Midstream folks, Tad, not so much necessarily. I'm looking at the Powder, and I'm looking at production in Wyoming is hanging at it keeps creeping to 300,000 barrels a day, and it keeps pulling back. And the Powder River, is a good chunk of that. The decline curves don't look amazing, right? Year over year, they're kind of So give us a high level of your position in the Powder. I want to talk about the Uinta. I want to get into that a little bit, but where you guys sit as a company, how you feel about the Powder. Obviously, I know when I was working with you guys, but where do you sit now, and obviously well cost, $60 oil, this all matters a lot. I still hear, as much interest as I hear in North Dakota, I hear equally as much interest on the powder. It's all about just finding the right rock and getting in there. And there's a lot of private companies in the powder.
Yeah, that's a lot to go over here. So yep. I know we have to.
Good time.
Sorry, we have to. Yeah, we have to watch. We want to stay within the hour, I think. And I don't want to fill up the whole hour because we need Tad to talk too. So the Powder River Basin, we really like it. As a geologist and all my geologists that work with me, we all like it because there's a lot to examine. There's been a big resource that has been generated in that basin. A lot of gas, a lot of oil. There's actually a lot of liquids and a lot of oil in that basin. That's the reason we really, focused on that piece and grew the company there. If you're not familiar with Anschutz, private company, we are the number one oil producer in the state of Wyoming, and that's coming out of the Powder River Basin. We're, over 600,000 acres in the Powder. We'd love to own a lot more. If anyone wants to sell out, give us a call. We'll buy you out. I doubt that's going to happen, but never hurts to ask, right? We like it. I think the averages people see from type curves or well cost, sometimes hide what's really happening with individual companies. I think you need to be granular if you really want to understand basin level economics. And, we've been running multiple rigs for 5 years now, and that repeatability and that activity level allows you to learn and improve as you go forward. Our well cost, I will tell the group here today, on average for the year, we're drilling, upwards of 60 wells in the Powder this year, or sub $8 million on average. Okay. And that's DC&E with hookup. And that's, a mix of development wells and some appraisal wells. So we have some single well pads we're drilling. They're not all, 4, 6 well pads. So we're not getting full benefit of full scale development. We're also I heard, the comment about North Dakota, we're extending our laterals as well. We did a number of 2.5 mile laterals last year. We did 3 mile laterals this year, Mowry and Nio. And our program for next year is going to be in excess of 20% extended laterals just in the Powder. So I think it works very well if you get in and focus and do the work that's necessary at a really detailed level to make it work for you as an investor or you as the company or the individual. But I think a lot of companies just aren't focused on the Powder. I mean, you got 3 or 4 publics and they're spending time in other areas and they haven't made it work. And that's their decision, I guess, on that piece.
Yeah, so this is great. I'm going to loop back to Tad in just a second, but I'm headed to London right after this because I'm speaking at the Oxford Institute for Energy Studies has an oil day, and they've been asking me to come back for like 10 years to talk about U.S. shale. And these are the things I take to them because they're going to look at this and say, oh my gosh, 13.8 million barrels a day. They didn't believe that could happen, by the way. But I don't think a lot of folks in the industry actually thought that could happen. And I think we really, last year we talked about this, but, as PetroNerds, I spent a lot of time on this and really the lateral lengths are huge. These longer laterals we were just seeing everywhere. We see them in North Dakota, but I mean, if you compound that, right, where in the Powder and what Anschutz is doing, they're not doing 20 wells at a time or 8 wells at a time or 4 wells at a time that you see in the Permian where you get all those efficiencies. So there's actually a lot of goodie left to get in terms of the efficiencies, but I really don't think we can underappreciate these longer laterals. Like that is why your rig count can be lower. And that is why we've held up production with a lot less wells because our completed lateral feet are quite long. So sorry for that digression, but Tad, okay, you're on the midstream side, and you can, if you want to give a little background on a little more about True Companies and your COO of Bridger Pipeline. We've known each other for a long time. I think I bugged you at a conference where you're speaking on the midstream, and introduced myself and forced you to be my friend, and got him on a board in DC. We've had a lot of fun. But now you're in the heart of both North Dakota and in the Powder, and you're in Wyoming. So how do you see all this? And how do you see it from that perspective? And I will ask how you see oil prices as well.
how do I see just the two different basins?
Yep, right now.
Okay, so
And where your footprint and where you're at.
okay, so just quick background on True Companies is family business, over 75 years in business. I'm part of the third generation. So I saw a couple people from our True Oil company in the audience somewhere. But we do everything from exploration, pipe supply, trucking, drilling rigs. Then I run our midstream operations, which is exclusively oil, and it's not. It's 99.5% oil. We have about, as far as the pipeline goes, we have about 4,500 miles of pipe, all in North Dakota, Montana, South Dakota, and in Wyoming, and then we own a 25% joint interest in the Pony Express line that goes to Cushing with Tallgrass. So that's kind of an overview. From our perspective, we've been in North Dakota with pipelines since the late 70s, I think 1978, 79, in that time frame, and ever since the Bakken came about, like when I wake up in the morning, when I go to bed at night, it's everything I have to do is to do with the Bakken. That's for 20 years, that's all I've done. And for those 20 years, the powder has always been like the next big promise. It's like from a midstream perspective, it's coming. It's going to be big. It's going to be big, and it just never was until Anschutz showed up, and then you guys seemed to figure out how to drill those. And I saw Tim in the back with 1876. They're getting some big pads, having some big success, and that's just great to see because from my perspective, the Bakken has always been there, and it just kind of went straight up, and the powder just kind of chugged along for a while, and then Anschutz in 1876 show up, and they figure out how to make things happen, and the powder's getting to be a lot of fun now. So
nice.
Yeah.
Okay. All right. Let's stick with that for just a second. From a midstream perspective, though, so when COVID hit, we had. Prior to COVID, we had. North Dakota production has come down. It's held up, I think, remarkably well for the oil price volatility we've seen, and also for 30 rigs. And that's why I say, better fracs. And I still think we're probably not maximizing our frac in North Dakota necessarily, but the longer laterals, just the learning curve, right? We've just done better. And there's so much focus on the Permian, we often don't appreciate the Rockies and the cumulative production. I say this to a lot of folks, and I put a slide. If you put Ohio, Utah and Wyoming, and you chart them together, they're over 600,000 barrels per day, and no one's talking about them. And that's growth that you've seen since 2020, just massive growth. So this growth that we're seeing, and we are seeing this in the powder and these companies turning along, how does this, we definitely have more pipeline capacity. We have some spare pipeline capacity out of North Dakota, out of the Rockies, when there were moments where we were kind of tight, right? And diffs blew out. And I remember hanging out with you, and Cat he cracked me up because he'd be like, it's, it was like kittens and roses and daisies, and now it's not kittens and roses and daisies. Where are we at now for, where the pipeline space is, where the spreads are? How does it feel? Is it kittens and roses and daisies, or is it, black licorice?
I think it depends on who you are. Really, like if you're, if you're trying to fill a pipeline, you need differentials to help support a tariff, which the producers don't like the differentials. What's interesting. So anyway, let's start with North Dakota. North Dakota, is there enough pipe capacity leaving North Dakota? The simple answer is yes. Is there enough pipe capacity leaving Wyoming? Again, the simple answer is yes. But it's as it continues to grow, it is filling up. The one thing that I would argue that North Dakota had too much pipe capacity, and just recently, Kinder Morgan converted their what's called the Double H line from oil to NGL service, and that did two things. Is that one, it backed up a bunch of oil back up into North Dakota, and the second thing it took a lot of oil out of the Guernsey market. So with that one pipeline, changing service from oil to NGL, the diffs Wyoming for the powder went from negative $2 to a positive $1. And and the reverse happened in North Dakota. It went from a positive $1 to a negative negative $2-3. So that's kind of where the differentials are sitting right now.
Yep, and that's meaningful when we start getting into lower price territory, and for some folks especially on the fringier stuff,
Right.
they can be very material.
Yeah,
Awesome.
absolutely.
Okay, so handed this to Nathan. All right, Nathan, from that perspective, you work with you're with the North Dakota Department of Mineral Resources, but your purview, obviously, we talked about longer laterals and this production and holding up this production. Prices there and this takeaway capacity. What are the things that folks are talking about in North Dakota as the biggest, that you here's the biggest things, both from the good side and from the bad side? Like what are the things, the headwinds? I know we talk a lot about the interest in North Dakota is strong. People love it. The rock is just awesome. I mean, it's a simple cookie formation. This is just like, we know how to get the stuff out. Is it as simple as that? I mean, what are we butting up against?
A good question. So for those that don't know, North Dakota has a differential to WTI of like $6 to $8. So that's certainly a headwind that the state has, and the way the industry has been combating that is longer laterals. I didn't mention it earlier, but I do include a graph every month on the director's cut, and it shows that the actual lateral length that's being drilled in North Dakota is actually rising, while production comes down just a little bit. And that is a direct impact or a direct effect of operators moving outside of the core and having to drill longer laterals. But some of the tailwinds that are happening in the state, you have an incredibly pro-energy, pro-business environment in the state of North Dakota. We're actively looking for ways to attract capital investment into the state. That comes directly from the governor, the legislature, former Governor Burgum, now Secretary of the Interior. Chris Wright's been up there. And so the entire climate in the state of North Dakota is generally pro-business, pro-energy. Most recently, legislature passed a development incentive a tax incentive where if operators come in and show innovative technology that unlocks additional reserves, they're able to get a tax reduction on the first 300,000 barrels produced, which essentially pays for almost the entire investment. There's a stripper well tax incentive. There's legislature most recently, relates to midstream, is helping fund open space on the west to east gas pipeline that is being built in, I think, 2027 to 2030. $50 million annually of space for up to 10 years, and that's a 1 BCF line meant to take gas from western North Dakota over to the eastern side of the state and power things like AI along the way, and get gas service, North Dakota Bakken gas into other areas, and probably less impact coming in from the Chicago market. So lots of tailwinds, a little bit of headwind right now with the pricing environment. But I would say recently, just a couple of weeks ago, I had the opportunity to sit down with Harold Hamm, and he spoke about a graph that he's been talking about. And it was kind of this idea that there's all this stuff going on right now geopolitically across the country, world tariffs all over the place, and a lot going on. But he spoke about this demand outpacing supply right around Q3 of 2027, and kind of this idea that there'll be a sharp price increase at that time. So I thought that was interesting. I've since heard that type of a discussion on another, I can't remember what it was that I read it in, but kind of the idea that right now we're in the $60 price range. We probably are for a little while. At least that's the thought in North Dakota, but the future is bright for oil production, oil prices. So,
no, that's great. Yeah, and I'll comment on the Harold Hammond prices, because if I had a nickel for every oil executive that said we're low now, but we'll go up, it'd be a lot of nickels. And I like Harold Hammond; he's been on the podcast. But just holding that for just a second before we pass this to Joe. What about sticks on the map? This is where, and we'll we're going to circle back before we close and talk about peak shale and everything. But, North Dakota is the one thing you can take to the bank is people do love the rock. I've been up to the geology class, the ones that Julie Lefevre put on, the rock jaw classes, they were awesome. And you cannot underscore and underappreciate like the rock. I think the rock has a lot left to give. I still have the 1970s report from Lee Price, I think, that was like the billions of barrels in the Bakken. And this is the stuff like I cut my teeth on the Bakken. I spent years, going to folks in DC, folks abroad, going to the Middle East, talking about this. People had a deep underappreciation of it then. And I kind of feel like it's, at least to me, it feels like people are still talking about like sticks on the map and the inventory is run up. So do you think the market's appreciating the rock? And do people think that we've drilled it all up and it's just they're counting the sticks on the map, or do you think there's an underappreciation of the rock right now?
Well, I think the rock's appreciated. The Middle Bakken is world class. It's some of the best. It's got a little bit more permeability than many of the other shale plays. Sticks on a map. I came into my role a little over a year ago. It took me probably 6 to 9 months to get up to speed to where I understood what that inventory meant in North Dakota. Recently, I've tasked our geoscience team with coming up with a new inventory in the state. But what we're going with right now is roughly 23,000 2-mile equivalent laterals that are sticks on the map in the Williston Basin. And that's at varying prices, $40 to $100 oil, wherever it doesn't. I don't have like a price on that where those work. But at the current rig pace, drilling roughly 900 wells a year in the state of North Dakota with 30 rigs, that's over 20 years of inventory in the Bakken and Three Forks. The trends that we're seeing, like I mentioned, 3-4 mile laterals, lease line development. At $60 oil, we're seeing spacing units come in with 4 Middle Bakken wells and no Three Forks wells in there. So do I think there's going to be infill drilling in the future, and that is a huge opportunity? I absolutely do. I think lease line wells, infill drilling, 3 and 4 mile laterals, U laterals, J laterals. We have federal lands that are still being leased that are tying up private minerals that we're continuing to work with the BLM on to ensure that we get those leased and don't stop development of private interests in the state of North Dakota. Where the growth seems to be occurring recently is kind of that Burke Divide County. For those of you that know North Dakota, Williams, McKenzie, Mountrail, and Dunn County are the top 4 oil producing counties, and they comprise well over 90% of the oil production in the state. But what we're seeing is these longer and longer laterals going north into Burke and Divide, a little bit southwest of Theodore Roosevelt National Park, southwest of Watford City in McKenzie County, eastern Mountrail County. We're starting to see some interest. So that's where we're really starting to see the growth. I do want to plug North Dakota as the number 3 oil producing state in the nation, 1.15 million barrels a day, and just very solid on the oil side. So that's what I'm seeing, Trisha.
Awesome. Okay, if you hand it to Joe. All right, so Joe, let's take it from a little bit from that same perspective, a little bit or same question. I do want to ask you about the Uinta. Do you guys still have a position in the Uinta? Okay, so we'll come back to the Uinta. Hold that for a second. Okay, so for the powder though, do you think it's being? You kind of already answered this, but $60 oil. And we have these private companies. This. We've had many meetings about this, but I've always thought that the folks that are in the powder like the powder, know the rock. If you listen to the podcast with Harold Hamm that I did a couple of years ago, he lights up when we ask him about the powder. Like he loves it. He's a geologist. And I think lots of folks think there's all this opportunity, but is it working? Is it going to continue to work at these prices? And do you think if it is it being underappreciated by the market?
So again, a couple of questions there. I'll try to.
That's fine. Take it how you want. Run with it.
For any basin where there's a powder, and I think everyone here probably knows this, you got to really take the learnings and improve on what you have. And the industry's proven to be resilient and creative. And use of technology or new ideas allows the business to continue to grow and evolve and support the United States from a security standpoint, and keep prices low for heating and people to travel and all this good stuff that we do as an industry that we get no credit for. Okay, I've been around long enough. I mean, I remember when 3D seismic was the hottest technology. Okay. Well, where do you think the United States would be without horizontal wells and fracking at this point? I guess we'd be riding horses or doing something, I don't know what. But I think the industry continues to do that. I mean, whether it's, the extended laterals that we all are starting to do in the powder, figuring out targeting, figuring out the geology, good, correlations, good mapping, understand over time how granular you need to look at the reservoirs to figure out where the best targets are to recover the highest percentage of oil, right, for what you're spending the money on. How do you lower your cost over time? What are the sequences? What is the asset development decisions you're making to get to those economics that you need? Those are all things that you have to do, and it takes time. It doesn't happen on one weekend working 2 days, right? It takes years to get there. So I think that we've put in. I think the powder has been overlooked. I mean, again, I think maybe it was overhyped early on, and everyone thought it was the second coming of the Permian Basin, which it never was going to be. It wasn't that big. It didn't have that much resources, but it does have a lot of stacked pay, and it has a lot of liquids and a lot of oil, which is more valuable today than natural gas. That's the economics of it, right? And so the basin has, and Chad, we know this from Tad, the takeaway and processing is all there for what it is today. If it doubles or triples, it's going to need a lot more investment from the midstream side. But I think it's a great basin, but you got to go and unlock it. You got to dedicate the time to do that. And I don't think a lot of companies want to do that right now. They have other opportunities they spend money on, but the industry continues to grow. The one I've been looking at is I call it the deep Haynesville, right? Everyone's probably seen that in the news lately. Think about those wells. I mean, 19,000 foot, the temperatures are dealing with 400 degrees. I mean, the industry is going to make those work. Now they're located in a good position next to the Gulf. But again, our industry has done a great job.
Yeah. And so this is what I think the powder is really interesting to talk about right now. And that's because when I say the Uinta, folks aren't paying attention to the Uinta in Utah, it's just amazing and prolific. But the powder is kind of this sleepy horse a little bit, and people aren't paying attention to it. If you've Utica, not to be confused with the Uinta in Ohio, people thought that sucker was dead too. And EOG is up there just pulling up acreage like crazy and amassing it, and production is going through the roof. And they're going after the oil that no one thought they could get because it was low pressure. And so you hear about this stuff, and you have to really follow this stuff intimately. And absolutely, these are the things that are missed by the Saudis, by people abroad. Like, they just can't get into the weeds on this. And so this stuff in Ohio and what's happening is amazing. But also, gas prices, yesterday we're over $4 an MCF. And the stuff that you hear when I listen to Liberty and I listen to the service companies talk about the Haynesville, these are monster wells, and it is difficult. It's super difficult to be in the Haynesville, right? Because it's thermally pressured, it's super hot. But gosh, these are monster wells when they come out. So once you crack a little bit of this technology, and we incrementally crack it to just, I think we run with it. So with all that, and sorry for that digression and that little nuance there. Tell us about the Uinta, or like not Utica, sorry, Uinta, Utah. What's happening down there? I mean, this was everybody talked about the waxy crude and talked about the takeaway because we couldn't take it away and we couldn't move it, and it was going to be a candle in the rail car, and you couldn't get to the refinery. But it has just ripped in production since 2020. Absolutely just like ripped. The decline curves look awesome, and there's a lot of optimism around it.
And yeah, I follow it. We're actually not in the waxy crude play. We're outside of that. More sweet crude and really a gas play. Liquids rich gas play would be the way I would say it. Uinta. It's a area that has not been heavily tested previously. So my saying internally and externally is it's Anschutz Exploration is the company name, and that's what we're doing. We're trying to explore and find some new reserves and go from there. So we're doing some testing on a position we have and have put together over many years, and kind of the southeast corner. Probably not a big secret, and you can see our wells and things we're doing down there, but nothing much to talk about at this point. We're trying to understand, the commerciality. Do things work? What's the infrastructure? What's the takeaway? Can we make money at it? Or do we, take some of our resources and go to other ideas and other opportunities we have as a company? So, we're in a different play, but no question, SM, if there's anyone from SM here, or 4 Points, right, getting pretty aggressive. It'll be interesting to see what happens with Barry. Do they sell the CRC sell that asset, which I suspect they will. So there's new players coming in, new investors, and I think that's pushing the growth up in various plays throughout the United States.
Awesome. All right, you want to hand it to Tad? All right, so Tad, are you dabbling in are you dabbling in the Uinta? If you're not, do you have any perspectives? And just from the former thinking about midstream and the takeaway capacity that several years ago everyone was talking about, and now not so much. And it just it does the positivity around it is really good. I think also for context, the Biden administration probably did help this a little bit. Prices helped it, but it's about 30. I believe it's over a third the Indian tribe owns, and they were not happy with the Biden administration telling them that they couldn't drill, and they basically sent a letter to say go stick it, and then they went ahead and drilled. So they have some incentive. But curious on how you see that on the takeaway side, the production, and do you feel the same excitement that I do?
Clearly not. But that's hard. That's hard, Trisha. I think hopefully everybody knows about the wax. It solidifies at 120 degrees, and it's the last thing you would ever want to do to put in a pipeline. But that's actually one of the things we're doing right now is we're let's see, Utah can take about, call it, think these numbers are right, about 160,000 barrels a day of wax to Salt Lake. It might be 180, somewhere around there. But that's a maximum that they can take. They can't take any more. So any production over that has to be railed out. So all this production is starting to be, for the last 5 years, has been anything over 180,000 has been railed to the Gulf Coast. We actually built a facility that went fully operational in May. That brings it, instead of going all the way to the Gulf Coast, it actually brings it up to Guernsey, Wyoming, where we are, we can blend it with Bakken crude and actually make it, able to put it in a pipeline. And just the shortened rail distance by itself, going from Utah to Wyoming is tremendously advantaged over going to the Gulf Coast, and so far it's from a pipeline perspective we've had no integrity issues, no nothing. It's worked really well.
Awesome, because it's not it's the wax is important. It is a light sweet crude. It's just it has this paraffin which becomes problematic, and I believe it's like 187,000 barrels per day is what the Uinta is producing, or what Utah is producing. Sorry, almost all of that is Uinta. And that is it was around 60,000 barrels per day in 2020. So it's a massive growth story that's just, I think, really cool and really good color on the midstream side. Does that, I'm thinking about this, you sitting here and thinking about oil prices, not that they don't matter to you, because obviously it would matter, if we go to $40 oil or if we go to 100. But in kind of between, 50 and 75, it's probably not, unless people are dropping production or they're increasing production, absolutely maximizing. It's probably steady Eddie for you, right?
Generally so, as long as the prices stay consistent. Generally so. The thing we really watch out for is the differentials, and because ultimately that will drive whether or not someone wants to ship oil down our line or not, and that's ultimately what it is. It's like, if differentials are high, your pipeline is in high demand. If differentials are low, then nobody wants to ship down your pipeline. And that's kind of what our focus is on. But we're always like watching the overall flat price, simply because if our customers are feeling the pain, ultimately it's going to come back on us at some point.
Okay, so I'm going to do kind of a last big question for all of you, and then we'll ask about peak shale, and we're going to open it up to the audience. Is there anything the market's missing right now? What's the biggest thing you think the market's sort of missing? And I say this honestly because the midstream perspective is a really good perspective from this, because you kind of have a little cooler head. We were talking earlier this year when people were kind of going bananas and losing their minds, and you and I are both kind of thinking they were going bananas and losing their minds. So what do you think the market's kind of missing? And this is the ham outlook the one that people should take to the bank, or is it kind of keep it steady as you go?
Well, I'll keep my my answers kind of focused on the differentials and the midstream piece of it. I think the biggest thing that's going to hit The Northern Rockies is the expiration of the 10-year contracts on Dakota Access. Those expire in June of 27. That's basically going to put, if those contracts aren't re-signed, that's going to put close to 500,000 barrels a day back onto the spot market. Now, I'm pretty sure they're going to sign up a lot more, some of that volume, but it won't be all of it. And I think that's the one big thing that we're kind of watching for, and we're starting to see things start playing out now.
Okay, awesome. All right, Nathan. Okay, so what about you? What are folks missing? Is it the private equity being super interested in North Dakota but not being able to get the acreage necessarily, or that's not peeled off from the public? It's like, what is if you were to say the greatest thing North Dakota has to offer that the market's missing, whatever? What do you think?
Well, I don't know that the market's missing it. I think the price volatility, $60 oil, that oil price in North Dakota kind of teeters right on the edge. So I don't know if they're missing it. They're patiently waiting, I would say. I don't look at any shale play in the country right now and see, boy, they're really ramping up the rig count. That's not occurring. It's not happening in North Dakota. Anywhere. We follow all the states. So I don't really see that happening right now. I think it's just being patient, waiting for the right time. North Dakota's in a unique spot right now. We're kind of the state of the super majors with all the consolidation that's gone on over the last few years. We have Chevron, we have Exxon, we have Conoco, we have Devon, Chord's massively consolidated companies up there. Continental, one of the largest private equity companies, or not private equity, private companies. So we have really, really, really large companies right now, and I think some of those have came into the basin recently. Chevron through the Hess acquisition, and I would fully expect that Chevron carefully disseminates what they have there over the next couple of years, and then figure out what they do with the basin. But they also have to gain capital efficiencies that they promised the market through the acquisition. And so there's a couple of rig drops occurring and a couple of companies picking up rigs. So I don't know that the market's really missing anything, but I think it's being very patient. And in North Dakota, I think with Devon bought Grayson Mill, there's just been a lot of consolidation there, and I think it's going to take a little bit of time to sort through what they have and what's going to happen there. I think there is opportunity for private equity companies in the coming years to jump into North Dakota because of that. So
awesome, great answer, Joe. Okay, so from your perspective in the powder, what's the biggest, I guess, and I do want to ask this about, right? Is there a hurdle? Is there a regulatory hurdle or a headwind? A single one that is you think that would help, and I do think getting costs down, that's been a huge thing for the entire industry, which we'll close on talking about that a little bit. But so headwind and hurdle and opportunity for the powder and I guess your business more broadly.
Yeah, so maybe the powder is applicable to probably the whole Northern Rockies in some aspects, right? And I may be saying things that people already know, but some of the headwinds we've always encountered is the high percentage of federal ownership in those lands, right? So right now we have a favorable administration, or a very favorable, I guess, or however adjective you want to use. I hope they stay in for a long time, but with that aside, that's going to cause more federal lease sales. We're already seeing a lot of acreage that during the Biden administration they would not even put up for sale. That's going to come. There's going to be a lot of leases that are going to become available. The question is, are the environmental groups going to sue after those leases are issued? And does that tie it up or not? Put that aside. So that's an issue. The whole permitting, and this goes to the midstream, the upstream piece, everything else. Is there a permitting reform that comes out of DC? Our company, myself, we've been involved with this, trying to push that through. That's something that the whole United States needs. And it's not just for oil and gas. This is for transmission lines, power plants, whatever it may be, solar, wind. This is something the United States needs. And the people in DC need to get this straight and get it passed while they can, because that would help the whole United States, the economy. I think those are things that we have to watch. I do think, the debt burden the United States has, and that's going to come home at some point. Whether it comes home near term or 10 years from now, who knows? But I think that's a risk on how much debt the U.S. has and what does that do to the economy. Those are things that impact us, maybe more macro. The Powder's not, or any other place in the Rockies is all impacted by those. But we try to just do our piece and make sure we got the right place to go and the right place to drill and how we sell our oil and gas and product and how we manage our costs. What's in your control is how we focus on it.
Awesome. Yeah, no, I completely agree. Resiliency and speaking my language with the macro. I want to loop this back to two last things, then we are going to open it up to the audience. But so regulation, like the macro does matter a ton. We have incredible geopolitical angst, geopolitical volatility. I am absolutely on the record for everyone thinks I'm an oil bull right now. And I guess I am an oil bull right now because I think oil prices should easily be closer to 70 than 60, given all the geopolitical angst. And it does matter for operators, but it's been a unique year because we have had, on the regulatory side, a very pro drill baby drill administration, but some angst within the industry of, not wanting these, being really pushed back on these lower oil prices and whether they're drill baby drilling. And I have to say, I think the industry has drill baby drilled because we have 13.8 million barrels a day of production. And these lower prices have pushed, operators to really do a lot more with less. I'm not saying that's a good thing. I also think the administration needs to know that the Rockies in particular, but the smaller producers and folks like you in the room, they need higher oil prices. And it's okay to have $70 oil in the US. In fact, it's a really good thing. $75 oil would probably be good for 13.8 million barrels a day of what it gives. But with that, this drill baby drill, I think that's one big theme if you want to comment on the three of you, and peak shale. So I think about this with Rockies versus Texas of this is, if I had to give two big things people talked about at the beginning of this year was everybody asked me about drill baby drill. And then everybody asked about, or was saying we're peaking shale. Now people are starting talking about plateauing. I have plenty of opinions on this, but I would love the perspective from the three of you. Whoever wants to start first on, are we at, what peak shale and Rockies versus Texas on peak shale and drill baby drill, if you want to take it.
Okay, I'll start. So I'll do drill baby drill. Just a saying, right? I think we're all here to make money. And so we're going to make decisions that are commercial or economic. We're not going to go drill what I call dumb wells to lose money. We're in here to make money and be profitable. So no matter what the administration or some politician has to say, we're going to do whatever is best for our business, our investor, right? And so we've actually slowed down. We started the year with 3 rigs in the Powder. We're at 2 right now for a couple reasons. One, prices aren't as great. Should we be drilling? The question we have internally in our office, should we be drilling our best wells at $60 oil? And you go, no, that's stupid. I can hold on for a couple of years and I can drill it under $70 oil, and my PV10 is 50% higher. I shouldn't do that. So we slow down. We're private. We don't have to hit any certain targets. We don't have a time limit on our money. So we're advantaged in that standpoint compared to a lot of other companies. We can go slower now. And our saying internally is we're going to go slower now to speed up later and be more profitable in the future. So that's the drill baby drill piece. And then, the peak shale, I think always what you need to say with that is at what price? Okay, $120 oil, we're all going to find a shitload of oil, as you would say. I've heard you say that before too, so I can say. So we're going to find like plenty. 13.8 will be nothing. Okay, just so you know, if it goes to $100, right? So I mean, I think the industry, again, like I said, is very creative and can learn and apply new technology. I do think, and I am a geologist, there is a limit. Okay, there's just not unlimited number of areas where oil and gas is present that you can get out of the ground that makes commercial sense at X dollar of oil. So you got to be talking about it from an oil perspective. And I also think, just like we talked about, I don't want to take up all the time, but all this new infill drilling, secondary fracs, whatever, unit line, well, there's all these things that we're going to do to help keep the production from dropping too far. I think it's going to be a very, very slow roll for the United States for a long time.
So plateau shale.
Yes.
Yep. Flat top, butte. I've been calling it this, folks. Yep. Okay.
All right, I'll touch on drill baby drill first. Maybe from kind of the regulatory side. When I think about that, I really think about that is really a term for a more favorable environment from a regulatory standpoint from the federal government side, and that's actually occurring. There's new rulemakings going on right now through many of the agencies in the federal government. And I know my agency at North Dakota, the state of North Dakota, is actively participating in those rulemakings and commenting where appropriate in order to help continue to promote activity in North Dakota. So, but I think this administration wants a strong economy. $100 oil probably doesn't do that. So I would think drill baby drill is great, but it doesn't necessarily mean $100 oil or something like that. The other top,
Peak shale, Rockies versus
peak shale.
Texas.
Yeah, I would just say that I would never underestimate. I guess I've got 26 years of experience in the industry, and I've heard about peak shale since I got into it, and I've never really experienced it yet. And so I don't know where it exists and when that happens. But what I do know and what I've seen and experienced over those years is, I never underestimate the industry to continue to innovate and find new technologies. And so, I don't know if I'm all into the peak shale thing, but just because every time prices are down, industry innovates and comes out stronger on the other side. We run less rigs and have higher production, and and it's meeting the demands that the world is having, right? Like I think 2030 we're supposed to have 110 million barrels of oil or something in that range from a demand side, and most certainly this industry will meet that.
Awesome.
From what I can tell.
Thank you. All right, Ted.
Okay, so when I started, production in North Dakota was about 98,000 barrels a day, and I remember seeing that's and then we saw some of the first horizontal Bakken wells, and a couple of people would come out and they were like, "Hey, Bakken is going to go over 300,000 barrels a day." So I was like, "You guys are smoking crack. There's no way." Then I remember we saw one. We were in a meeting and this Canadian consultant came down and goes, "No, guys, I think Bakken's going to go to 600,000 barrels a day." I was like, "Yeah, no." And every time it just keeps going. And so, for my entire career, it's the one rule that I live by a lot of rules, as Jen's number one right there. But never going to underestimate the Bakken, for sure. Never underestimate the Bakken. So that's my answer to peak shale. It's
That's awesome.
I don't know, but I'm never going to underestimate the Bakken.
That's fantastic. And Tad and I, when this was starting, when the Bakken was starting, and that's when I cut my teeth on it, when I was working in DC at a nonprofit, I was the Bakken girl in DC. And I was like, literally, we bought HPDI data, which is former drilling info. And I had to beg my boss to spend $5,000 on this. And so I'm going to talks, and I'm at Brookings and CSIS, and I'm doing this, and I'm literally presenting, and I'm saying North Dakota's producing, and it was like 600,000 barrels per day, and EIA is like, no, they're producing like 100, and I'm like, your data's wrong. I mean, it was amazing. It was EIA and me, and I'm like, holy smokes, we're off by 500,000 barrels per day, and that was when things were turning. And so it's this perspective I think is just awesome of thinking of this context for peak shale. So we'll wait for the round of applause, but I would love to open this up to the audience. Thank you guys so much for being here, and let's hear your questions. We are going to run 5 minutes over because we started a little late, and I'm a more is more kind of person. So, yep.
So this is a question for Nathan. I think North Dakota is probably number 2 in the U.S. for states for data centers. How do you see that fitting in with continuation of an active, strong industry?
Yeah, that's a great question. There's a lot of momentum in the state around that. The Department of Commerce is all over that. This west-east gas pipeline is one of the secondary benefits of that is specifically AI. There's stranded gas to the tune of about 150 million a day, and I've up in the Williston area, I know the local senator up there, and he's very interested in bringing AI up into that area. As you go farther northwest of Williston, there's areas where current rates. It just doesn't make sense for gas pipelines. So I think localized centers for AI are going to pop up. Representative Fedorchuk talks about this. Senator Hoeven, Senator Kramer, they're talking about it in national news all the time. A lot of momentum. Also, the climate. Who would have thought that the climate in North Dakota is good for Latin February? But apparently, these AI data centers like the cooler climates. So there's a lot going on, and I look forward to watching that over the next few years. Lots of discussion on it in the state. Good question. Thanks.
Oh, come on, guys.
I have a question that touches maybe a combination of the regulatory environment and the exploration environment. It seems like there's so many things that operators are doing to try and innovate from a DMC perspective. But still, when you look at maybe over the last 6 years, the vast majority of wells in Central Rockies basins are north, south, and east, west. A lot of that has to do with regulatory. Some of that has to do with operational efficiencies. Is there anything that you see operators doing with regulatory entities to try and ease that restriction so that, operators could maybe be more efficient or they could gain the efficiencies of optimally oriented laterals here and there, as opposed to just being stuck with north, south, and east, west DSUs across the world?
So I'll start with that one. I guess, we've done a lot of work internally to understand the stress regime and those directions. And we've drilled east-west, we've drilled north-south, like you said, and, studied the pressures via the completions and all that, and looked at the results. And we don't see a lot of change between the two. And we've compared it to diagonals, let's say 45s or something like that. I think it goes to broad, and I'm talking broad sense here, across the Rockies. I think, it's a little agnostic to where you need to go. Maybe there's some uplift by orienting your wells at a 45 or something, let's just say, for today. But I don't know if it's enough to generate the return that's necessary to do so. Anschutz, we're a big believer in state or federal units that give us control over much larger areas that allow us to develop however we want. But we haven't found the justification or reason to do that. But that's just us.
I guess from a regulatory standpoint, and I'll just speak to North Dakota, largely spaced on 1,200 acre spacing units across the state in order to minimize the surface impact, these energy corridors. But what we're seeing on a monthly basis is lots of 1920s and 2560s coming in, and it doesn't necessarily matter what direction from what I can see. So operators see their operation, and we see every operator's operation coming in the door from a spacing unit standpoint. So at least in North Dakota, boy, it doesn't seem like it's really slowing down or stopping that type of development. I would say in our state, come in with your spacing application. Make sure that you've thought through your surrounding lands to make sure that we don't strand resources, and then come on in, and we'll talk about it. So that's a little bit of a regulatory perspective. Yeah.
Come on, any more?
Yep. So, Nathan, no one thought you could flood the Red River B in Bowman County.
Mm-hmm.
And EOG is in the process of forming a fairly massive unit, the Ross unit. And I'm just curious, do they intend to water flood that, or are you CO2 from the lignite plant? Do you know?
So are you talking about a unit much farther to the southwest part of the state? And a little bit more context.
No, it's up in the heart.
Okay.
The heart of the Bakken.
Yeah, the units that I know of that are being considered up there are for infill drilling type reasons, and the ones that we've approved to date. The ones that in the future I can't speak to those, of course. But yeah.
Right. Yep.
This would be for more possibly for Ted. we've seen a lot of things that, it seems like the market is always focused on international, variables that can affect pricing. As we get through more of tighter regulatory restraints, and you see that there are states like North Dakota that are open for business, there are states like Colorado that are closing for business. There's a lot of legislation that's making some, what I would call irresponsible decisions on future energy. You see the interstate markets creating a lot more competition in the future than they are
For me, it's I deal with 99.5% oil, and so my only market for oil is a refinery. So unless a refinery gets built, that's the only place that I'm going to go. So I don't. Right now, we're just. Joe mentioned the possibility of permitting reform. In my mind, there could be nothing more important that this country needs to do is go through some level of major permitting reform for all for crossing any federal property. But the reality is for us is until a refinery gets built, we're just going to be stuck with interstate commerce.
So yeah, we've got the regulatory question is great. I'm surprised no one asked about the DJ because we didn't talk about it. Colorado's producing 465,000 barrels per day, but nobody's knocking on the door to say, let's rip in Colorado because they can't, they know that Jared Polis is pretty anti doing anything with the state. The way I think about this is a couple fold is that, I think from the midstream perspective of back in the day when we did have massive differential blowouts, right? Where we had, $10 between West Texas Intermediate and Brent. And that was a big problem. So permitting reform is number one. I have a hard time with it a little bit because we understand it in the industry. Washington has a harder time. And I've spent, I was in DC early in September. Everybody's talking about permitting reform. It's the next thing. But exactly what? Exactly what is it that they need? And they really do need help understanding what is it exactly that has to be reformed. And I think that it's kind of everything, right? I always drill down to people of you have to build for natural gas. You have to build pipeline. You have to compress this stuff, right? And so if you have oil, you're going to have some byproduct natural gas. You have to put it in a pipeline. You have to build compression. You have to do all these things. And then natural gas is awesome, but you have to do all this stuff to it. And then you have to put it into LNG, and then you have to export it, and then you have to get it abroad. Then it has to be turned back into nat gas or turned back into a gas. So there's a lot there. And so the permitting reform, it's unbelievably huge. It comes from simple of let's address NIMBYism because we're talking about rare earth export restrictions from China. We have to build, we can mine for the rare earth. So we need to do permits on just let's mine for it. This administration is working on permitting reform for just we can now mine for coal in the US. We have basically had a de facto moratorium for decades, basically since Obama. Now we can actually mine for coal, but you have to have the incentive to do it. And the most importantly for rare earths, let's mine it. So get the permit to mine it, but we have to process it. So on refining for crude oil, it's the same thing. We haven't built new refineries in a long time because it's so damn hard to get a permit. And so we expand refineries, and during the shale revolution, we've tinkered with these refineries. Now we are going to have to stretch our wings and realize that we are going to have to build stuff. And in the word, we're going to have to build shit. We're going to have to build a lot of it. And refining rare earths is one of those. And so permitting reform, the ability to just build is huge. And so for the oil and gas industry, I think it's really, really critical is that something we're not hearing enough of in Washington is this, when we talk about peak shale, I think it's important. How do you maintain 13.8 million barrels per day? How do you make sure you don't lose that? And having access to permits, making sure that you can change the orientation of your well, making sure you get a pipeline built when we need it, really, really important. And I say this, and I hope people don't think it's just I'm being callous about it, but we built the big inch pipeline in World War II in a year. We need to get that back. We need to get that kind of muscle back. We built the USS Midway in a year, in 12 months, in 1944. We have got to start being able to build things. And that is a lot of the executive orders and a lot of the tariffs, like it or lump it, that's what they're about. With that, if there's another question, otherwise, I think I'm going to thank you to the panel, Joe and Nathan and Tad. Really appreciate you guys attending. Really appreciate you guys being here. It is a pleasure to be on the board of the Denver Earth Resources Library. If you don't know me, my name is Trisha Curtis. I am the CEO of PetroNerds, the host of the PetroNerds Podcast. We will turn this into a podcast. They're going to be able to edit anything they don't want in there, but thank you guys so much.
Thank you, guys.